Hey guys, welcome. Whitney here. We just got a few more people rolling in. I'm going to give it a couple more minutes. But thank you so much for taking the time out of your morning to join me. We've got another episode of our How to Get Started as a Passive Investor series. And if this is your first time joining, just make sure to jump over to the chat box and let me know if you can hear me and see me. That would be fantastic. Also, hold on. Okay. Well, let's get started. Oh, we got a couple more people rolling in. Okay, awesome. All right. So if this is your first time joining one of these webinars, what we are here to do today is to teach you about about investing. So what we're going to tackle today is what the capital stack is, okay? Why it's important that you invest in the capital stack and understand it before you invest, and then just exactly how the capital stack affects you as an investor. But these webinars are for you if you've, maybe you've tried to invest in syndications before but got cold feet, or invested in syndications before but realized, oops, I made a mistake. Or maybe you want to invest in syndications, but just with all the information out there, you've just gotten into complete overwhelm and information overload. If that's you, you are in the right place. So I like starting off with these webinars, kind of busting through a couple myths of what keeps investors sidelined from investing in syndications. And there's two things. One, they feel like they don't have control, okay? And I've done a few webinars to speak to that piece. Like, yes, you do as an investor have quite a bit of control when you invest in syndications. And I'll point that out, those different episodes out to you here in a second. But the second biggest myth that we need to bust through when we talk about syndications is that you won't make that high of a return. I know a lot of investors come from owning their own single family or small multifamily portfolio. That is how my husband and I started off. And, really, like, when we were totally convinced owning that active portfolio was what was going to give us the greatest leverage of our money. And it's simply not all the time is it true. So if you haven't met me before, here's me and my crazy family. This is my husband and my kids, my child. This is us on our last out of the country adventure, and we're looking forward to taking many more here really soon. But again, we started off fix and flipping, in 2002. My husband joined me in 2006. And then we realized that we just had buckets of money and that we didn't actually have freedom. We just had another job. So we needed to figure out a way to convert those buckets of money into passive income. And so we got started off, like many people do, in rentals and scaled our portfolio to about 30 rehab units. My husband was my biggest cheerleader. And then at that point in time, I wanted to step aside and step back a little bit and spend more time with our daughter. And then my husband was like, that's amazing. You're able to do that? And I want some of that. And that's when we were like, oh boy, I need to add now probably another 40, 50 units to replace his income and benefits program. And that's when I decided we have got to find another way to scale. And we chose to go into multifamily real estate. We started off as limited partners and then also have moved into the general partnership. And that's when I found Annie and Julie and joined Goodegg Investments. And fast forward, we have closed over 25 deals in the multifamily space, have 6,500 units under management in the multifamily space, and a $790 million portfolio value in the multifamily space. So we are super excited about those numbers. And we're coming up on 3 years. So we have done quite a bit of investing over time. But what I get to do on a day in, day out basis, daily basis, is work with you guys, our investors. And as you can see, we have a pretty high repeat investment rate. And again, if this is your first webinar with us, this is just a few insight into a few of the things that we've done over the past year. Yes, even while in the middle of a pandemic and COVID, we've been able to put out a book, launch our podcast, attend conferences, meet with many of our operators, and with many of you, our investors. So as I promised, I do like a little recap and kind of point to you, point you in a direction of other topics that we have covered in this series. And again, those topics that have really speak to how you can have control when investing in passive syndication. So when I send out a recap email today, it'll have a link to this video. Amazing. You'll be able to come back to it and watch it at a later date. Also, you scan down that email towards the bottom, there'll be links to other webinars that I've done that speak to the different tenets of conservative investing, how you can actually, the 3 secrets on how you can control your investment. We do underwriting tools in there. We break down the PPM. We talk about all the risk and rewards of passive investing and how to mitigate the risk. More importantly, the different tax factors of real estate. I get tons of questions day in and day out about how can syndications help me tax-wise. That's a great video for you to watch. A lot of questions around how people can fund their deals and which is the best way for them. I've done a webinar on that. But what we are here to talk about today is the capital stack. Okay, we want to understand what it is, why it's important, and for you as an investor to understand, but also how does it impact you and your return? Okay, because remember, we said one of the biggest myths that investors have for getting started in syndication investing is that they don't think they're going to make that high of a return, okay, which is not true, okay, but we do need to understand where your return lies in the capital stack, all right? So just to let you know, we are not a legal, financial, or tax advisory firm, so make sure you consult any tax professional or legal or financial professional for that type of advice. And anytime you see any sort of pro forma for us, we don't include any sort of tax assumptions into those calculations. And again, those assumptions will not be made here. As we go through this, the capital stack, if you've invested in a few deals, you've probably seen this in the PPM. If you've never invested in syndications before, this might be a really new concept for you. So I want to make sure that you have found your chat box. And if you have a question, go over to that chat box, type it in, and I'll try to answer the questions in line. Otherwise, we will clean up those questions at the end. And guys, this is really kind of the cool concept about being here live is that you can ask any question that you want, and I will clean up those questions at the end for sure. Kind of like a little mini Ask Me Everything. What do you call it? Ask Me Anything type episode. So let's talk about the waterfall first. So the waterfall is, how the capital stack works, okay? Remember, we're going to define that in a second, but let's talk about the waterfall because that's often the term that's used in the, when you're talking to an operator or looking in the PPM. Essentially, the waterfall, okay, and the capital stack that determines who gets paid when and how they will get paid. And when a partner, limited or general, gets paid in an apartment syndication, okay? So as an investor, you need to understand where you stand in the capital stack to figure out what parts of the waterfall apply to you, okay? Now, this is something that I have really taken great care to focus on in my education with investors, is especially for newer investors that are coming over into syndication. I think they think, a lot of times they think that they are a part of the debt, okay? But a limited partner is exactly that. They're a partner, and they take an equity position in the project, okay? So any sort of returns paid to the limited partner and to the general partner is behind all expenses, fees, and debts being paid. Essentially, it's the distributable cash flow of the project. Okay, very important for us to keep in mind that concept as we move through the stack. Okay, and understanding how the capital stack works, how the waterfall works, will determine a few of your returns, right? It can determine what kind of cash-on-cash return you get, or a preferred return. It can actually determine what kind of IRR you get on the project and an internal rate of return. And it can determine what kind of velocity you can get with your money, okay? One of the cool things that we like doing, and we never put this in any of our pro formas, is especially in our value add projects, we will look to do a supplemental loan or a refinance after we've executed majority of our business plan, because we've created an immense amount of value, and our return on our equity might have dropped, or excuse me, our loan to value might have dropped from say 70% down to kind of 40%. We want to be able to remove some of that equity from their project, and when we do that, we can return capital to investors, depending on where you are in the capital stack. Not everybody gets capital returns, so we want to make sure you understand if and when, how you invest when you get capital return. But the cool thing, when we return capital in that mechanism, it's tax-free, okay? And now you have that capital back, and you can go earn returns in 2 places. So again, we are kind of busting through that myth that you can't make as high of a return when investing in syndications. Okay, I've actually invested in a few syndications myself privately, and I'm always excited whenever there's a supplemental loan or a refinance that happens and I get a chunk of money back, and now I can go invest in another project, amplifying my, my initial return, say from a 7 or 8% pref to maybe like a 16% pref, okay, because I'm now in 2 projects with the same dollar. Okay. So let's back it up. Let's talk about how the whole capital stack works, okay? So remember, we talked about this, the capital stack or the waterfall, which is who gets paid what when, okay? That's essentially boiling it down. So the stack is like this. We are gonna order it based on risk and priority. So the senior debt is in the top part of the capital stack, okay? They are taking the lowest risk position and they're the highest priority, okay? So they're probably only getting, say, like a 3% return on their money or a 4% return on their money, okay? They're pretty low in the capital stack, all right? We closed one deal recently that was a 2.75%, okay? So they're getting pretty low returns on that money. Then the next part of the capital stack is still debt, okay? This is still the bank, all right? And it could be in the form of a second or a supplemental loan on the property, usually, or a bridge loan, like mezzanine debt, okay? They take a little bit higher risk than the senior debt and a little bit lower priority than the senior debt. But again, their return is still pretty low on their investment, okay? Then the next person in the capital stack is going to be preferred equity. Okay, this is oftentimes going to be the limited partner. Now, the way we structure our deals, or a couple ways that you can see deals structured, it may, as a limited partner, you might participate in both the preferred equity and the common equity. Okay, and I'm going to show you 2 different structures. But preferred equity will come next, meaning they get paid first. So if you see a deal where it says 7 or 8% preferred return, that just means that whoever's in that position, that investor, will get dibs, so to speak, on the first 7 to 8% of the distributable cash flow. Again, they are taking a little bit higher risk than the mezzanine debt, but a lower risk than the common equity position, which is generally the general partnership. And they take a higher priority of getting paid over the common equity position. Okay, so this is the basic stack. Now let's look at a couple different ways that we put our deals together that constitutes what we call the waterfall. Okay, so in our single tier investment stack might look like this. Okay, so we'll take out a senior debt position of about 70% loan to value. Again, their risk is low and they have the highest priority of being paid back. Okay, and then the next class will be considered Class A. Okay, and then the general partnership will be in Class B. Now, the Class A might still have a preferred return attached to it, but we consider them both common equity classes, and we'll split the deal 70-30, 70-30 to the Class A and then 30% to the Class B. Now, we'll give a preferred return to the Class A, generally somewhere between 7 to 8% preferred return, and that's it. We just split the profit 70-30, distributable cash flow from monthly income as well as the equity on the back end sale. In this case, the Class A is participating in common equity. So if there is a refinance, they will get capital return because they are sharing in a higher risk class. Okay, they will get capital, some of their capital return, and then also in the sale of the project, they will participate in the gain on the back end. Okay, that's kind of what a single tier looks like. Now let's take a look at a dual tier project. All right, this is becoming more and more popular. I'm seeing in the syndication space for a couple reasons. One is that we can provide a higher cash flow to Class A investors. Okay. Now, but it comes at a, it comes with, I don't want to say strings, but there's a trade-off because that means on the Class A, if they get a higher cash flow preferred return, they generally are not participating in any capital event. So if there's a refinance or a supplemental loan, they're not getting any capital returned. And then also in the sale of the project, they're not getting participating in any of the gains. All right. So in this case, we've got our senior debt. Then we have the preferred equity class, Class A. All right. They might just get a straight, say 9 or 10% cash preferred return. That's it. That's all they get. There'll be no bump ups or additional payouts for years where cash flow goes above the preferred return. They're not getting any capital returned. If there's a supplemental loan or refinance, and they're not participating in the back end of the deal generally. Then now we kind of go into the structure that you're probably a little bit more familiar with. Class B, again, is a common equity investor, but they're going to have a preferred return, probably somewhere around 7%. Now they're going to be positioned behind Class A. Okay. So in that common equity piece, they're going to get, Class A will get their preferred return paid out, then Class B, their return, preferred return paid out. And anything above and beyond, that preferred return will be split in some form or fashion with Class C, okay, in both cash flow and the gain, all right? Also, Class B will get to participate in any sort of refinance or supplemental loan on the property, and they'll also participate in any equity or capital gain on the back end of the project, okay? So if you're looking for just probably, and again, every PPM is different, okay? So you wanna make sure you review your PPM, but if you're looking for just kind of straight cash flow, you might wanna look for a dual tier stack that offers a Class A investment, okay? If you're not concerned in the upside at all, that Class A might be a good fit for you. If you are looking for a balance between a return and equity, then the Class B might be a really good investment for you, okay? Now, here's the thing. There's generally, in this dual tier stack, Class A has to make a larger investment, so the investment minimum might be, say, $100,000, and there's only so many shares, okay, to Class A. So it's not like the whole deal can be invested in Class A. There's generally probably less than 30% of the deal's shares are in Class A. Okay, so those are kind of coveted spots. All right, so let's practice a little bit. This is a deal that we did fairly recently. And this is kind of how it would look and be notated in your investment summary. As you can see here, Class A, they participate in cash flow, and if we break it down between cash flow and membership ownership, the capital gain, Class A just gets 9% preferred return, straight cash flow, and 9% preferred return to the investor. So essentially, that's their cash flow that they've been accruing over the course of the project. Now, Class B, it will be dictated or outlined a little differently. You see here, there's a difference between the cash flow and the ownership. Here, there's a 7% preferred return to investors on the cash flow, 70-30 split thereafter on any other distributable cash flow. And the membership ownership works a little different. On the membership ownership, on the gain of the property, 70% will go to the preferred investor, up to a 13% IRR. So this is what this type of waterfall is called, an IRR hurdle. And then after 13%, the profits between Class B and Class C will be split 50-50, okay? So as you can see here, Class C is not participating until right here after the preferred return on the distributable cash flow of the Class B partnership. All right, we've gone through a ton of information in a short amount of time. Again, just I go into way deeper into the waterfall and the different types of waterfalls that there are in another video. But again, I just wanted to kind of back it up and help you guys understand how the capital stack is organized, what it means. As you can see, you know, we've got the debt, the bank debt on the property, and then the capital stack, you know, where we partner with our investors is going to be on the preferred equity and the common equity pieces. And that it comes kind of in two different flavors, either a single tier stack or a dual tier stack. And I think I wanted to help you guys understand, like if you were looking at an investment, what are kind of the different ways to view, according to your investment goals, the Class A and Class B. Okay, again, the Class A is going to be generally more than likely a higher cash flow, but no participation in the gain of the property. And then Class B is going to be a balance between cash flow and gain on the property. All right, we have covered a ton here. So if you guys have any questions, jump over in the chat box, type them in. While you guys are typing in your questions, I just wanted to kind of, if you haven't already, if you're looking to, you know, get an insight into our deal flow, make sure you check out the Goodegg Investments, Goodegg Investor Club. You can go to goodeggинvestments.com/invest. Make sure you apply there. We do 506B deals every once in a while, and you need to be, we need to have jumped on a call. Okay, so apply to the Goodegg Investor Call. You'll also get a link to schedule a call with me, and we can jump on a call and go through your investing goals. The Goodegg Investor Club is good for anybody, like whether you're starting out, doing this on the side, or haven't invested in a deal yet, or maybe you're a pro and you're doing this full time and you invested in several deals. Make sure to join that Goodegg Investor Call, or excuse me, Goodegg Investment Club. All right, couple questions coming in. You guys jump into the chat box and let me know what your questions are. Are waterfall and stack commonly used terms within the syndication industry, or just Goodegg terms? Oh, they are commonly used. You know, I don't know if they're actually like written out in the investment summary, but if you're talking about an investment with an operator, you can expect for them to refer to the capital stack or a waterfall pretty regularly. So the waterfall is probably going to identify more. The capital stack is what it is. Like this, the capital stack is going to be how the senior debt and the preferred equity and common equity line up. Okay, the waterfall is going to indicate what type of stack it is. Okay, basically, you know, how is the waterfall? What are the nuances of that particular deal structure you're looking at? Okay. Awesome. What other questions do you guys have? And again, if you're looking for more information on the waterfall, make sure when you get that replay email today, you scroll down and I go pretty in depth on 5 different waterfalls. Not all of which we do, but 5 different types of waterfalls you might see in the syndication space. All right, guys. Well, short and sweet, baby. Thank you so much for joining today. I will, continue answering questions as they come in, but just to kind of put this in front of you, if there's other topics you would like to see covered, make sure to let me know that as well before you leave. And for, those of you who need a jet, here's my contact information. You can jot down, Whitney at goodegginvestments.com. Otherwise, make sure to check us out on the Goodegg Investments Goodegg Investor Club page. Question came in, the operator is only in the C. Well, I don't know if that's a question or a statement. Yes, the general partnership is going to be in the common equity class. And in this case, the class, if it's a single tiered stack, it'll be notated in class B. If it's a dual tier stack, it's in class C. That's what you're looking for. You're looking for the general partnership to be the highest risk, lowest priority position in the deal. Next question. With our investment, do we really own a percentage of the property that we have participated in? So what we do is we take the property, and the property is owned by an LLC, okay, single asset LLC, okay, designated specifically for that property. There's no other entities held in there, or excuse me, properties held in there. And investors own shares of that LLC. So yes, but it's got a different flavor. You're not directly on the title of the asset. The LLC holds that, and essentially you're buying shares of the company and would be listed in the operating agreement. So, you can, like, say you're going through some sort of refinance of a personal property, you can request a letter that what we call a fair market value. And then the fair market value letter, you could be used as, an asset income or an asset for the property, or to substantiate, doing the refinance. It's like owning a stock of Amazon. I don't think so. No, because Amazon is publicly traded. This is not. This is what we call a private equity position. So we're not. There's no market for trading these assets. This is a single asset entity. We're looking for partners that come into it. Yeah, right. Like, so there is no so the question is, we can't sell. So whenever and it's outlined in the PPM as far as like what you can do to trade shares of your asset, your investment in the property. But no, our limited partners are exactly that. They're partners in a project. Think of it this way. This is how I explain it to people. I'm asking, 50, 60 investors saying, hey, you want to go buy a property with me? Right? And we're all like pulling money to go buy the property. Okay. It's not a traded stock certificate where there's an open market that you can trade back and forth, and where there's no vetting of the actual investor in the deal. So there's a ton of differences between the two. But I guess if we're getting super, super simplistic, that's how possibly you could think of it. Yeah. But very different. Private equity placement. Yeah, you're very welcome. All right, guys. Well, I'll hang out here and answer any more questions, but just wanted to kind of wrap up. If you're not already in the Goodegg Investor Club, here's how you can apply and hop on a call with me. And here's my contact information if you have additional questions. And thank you so much for investing your time and being here with me today.